Hello everyone, we are from Group 3. Today, we will discuss about analyzing financing activities. Before that, let me introduce our member. First, Arifrahman Hakim. Second, Ayu Savitri, and me, Aura Josiana. So, our material divided into 6 sub-bab. First is debt financing, the second leases, third contingencies and commitment, the fourth off balance sheet, fifth shareholder equity, and the last is post-retirement benefit. Okay, let's move to our first material about debt. What is debt? Debt is referred to fund that company has explicitly borrowed from the various provider of capital. Company may borrow directly from investor by issuing securities such as bond, and it is called public debt. And the company may also borrow from financial institutions such as bank, and it is called public debt. And based on term, there are two types of debt: long-term debt and short-term debt. Usually, long-term debt to finance long-term project or to meet sustained needs for capital, and for the short-term debt, primarily used for financing working capital and other liquidity needs. Okay, next about accounting of debt. First, you need to know what is effective interest rate. It is rate that market assigned to the bond at the time of the issuance. Next, what is bond discount? It happens when our bond have lower rate than effective interest rate. So, we sell the bond below the face value. Why? Because the return is lower than the other. And what about bond premium? It happens when our bond have higher rate than the effective interest rate, so we can sell our bond above the face value. Next, we move to the debt-related disclosure. Companies are required to report detail regarding their long-term and short-term debt in notes to the financial statement. In addition to explaining the amount recognized on the balance sheet, the note disclosure provides other useful information. This includes information regarding anticipated future maturities of debt, detail of contractual provisions such as collateral and covenant, unused balance line of credit, and any other pertinent information relating to the company's debt. Let's move to the analyzing debt financing. There are 4 points here. First, amortized cost versus face value debt. It is typically reported on the balance sheet at amortized cost. This can differ from the amount due at the maturity or face value. Next, about fair value. It also reflects the present value of debt. The third is future debt retirement. It is important for analysts to carefully examine the future debt payment schedule. At the outset, it helps with the cash flow forecasting. At the deeper level, the analyst has to evaluate whether the company has ability to repay its debt when it matters, because an inability to do so could potentially lead to the bankruptcy. And the fourth is unutilized credit line. All available credit lines are in the form of short-term capital financing. Therefore, this line of credit can only be used to specially finance the company's working capital needs. Okay, next about protection. Lenders often have explicit contract with borrowing companies which help the lender protect the money that they have loaned. Typically, there are 3 ways in which lenders protect themselves. First is seniority. It refers to the order in which different parties will be paid when a company or business is dissolved. Senior claim will be paid before the junior claim. It is the example of seniority. And the second is security. It refers to assets that are set aside during the dissolution to specifically satisfy a particular claim. For example, short-term finance is usually secured by current assets such as inventory. And the third is covenant. They need to establish covenant to safeguard their investment. Covenant can be either affirmative or negative. Affirmative covenant specify action that management need to take to keep the debt in a good standing. The negative covenant limit the management behavior that might be harmful to the lender. After we know about protection, now we move to the analyzing protection. There are several points that we will discuss. First is senior debt is less risky than junior debt because it gets paid first during the company dissolution. And the second, secured debt is less risky because there are explicit assets that transfer to the holder of the secured debt during the company dissolution. Therefore, a credit analyst needs to rate secured debt more favorably than unsecured debt. And next, paradoxically, secured debt typically carries higher interest rate than unsecured debt, suggesting that it's more risky. This occurs because only the riskiest companies issue the secured debt. And next is covenant tend to act as early warning mechanism for lender. Last, not only should an analyst keep track of actual covenant violation, but he or she must also estimate covenants like or margin of safety, which is measure of how close company is violating its covenant. Okay, we move to the second material about leasing. What is lease? Lease is a contractual agreement between a lessor and the lessee. It gives a lessee a right to use the asset owned by the lessor for the term of lease. And how the accounting and reporting for lease. Lease classified and account for a lease as a capital lease if the inception the lease meet any four of criteria. First, lease transfer ownership of the property to the lessee by the end of the lease term. The second, lease contain an option to purchase the property at the bargain price. Third, the lease term is 75% more of the estimated economic life of the property. And the fourth, the present value of minimum lease payment at the beginning of lease term is 90% or more than the fair value of the lease property. And lease can be classified as an operating lease only when none of these criteria are met. Next, about lease disclosure. Accounting rules require a company with a capital lease to report both lease assets and lease liabilities on the balance sheet. Moreover, all companies must disclose future lease commitment for both their capital and uncallable operating lease. These disclosures are useful for analysis purposes. Okay, now we move to analyzing leases. The impact of operating leases on financial statement as follows. First, operating leases understate liabilities by keeping lease financing off the balance sheet. The second, not only does this conceal liabilities from the balance sheet, it also positively impacts solvency ratios such as debt to equity are often used in credit analysis. Third, operating leases understate the assets. Fourth, operating leases delay recognition of expense in comparison of capital leases. And next is operating leases understate the current liabilities by keeping the current portion of the principal payment of the balance sheet. And the last is operating leases include the interest with the lease rental and operating expense. Okay, next we move to converting operating leases to capital leases. To convert operating leases to capital leases, we need to estimate the present value of operating lease liability. The process begins with an estimate to the interest rate that we will use to discount the project of lease payment. Okay, next material will be handled by my friends. Time is yours.
Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Ayu and now I will continue the presentation. The next about contingency and commitment. Contingency is represent potential gains and loss whose settlement depend on one or more future events. Contingent liabilities are obligations related to uncertain future events which may result in a gain or loss. Okay, next about basic of contingency. Contingency liabilities if a loss contingency potential claim on a company's resources. To record a contingency liabilities and loss, two conditions must be made. The first one, it must probable that an asset is impaired or a liability incurred, and the second, the amount of loss is reasonable estimable. To disclose contingent liability and loss, there must be at least a reasonable possibility of incurred. And the example of loss contingents, the first one, litigation, threat of expropriation, uncollectability of receivable claim arising from warranties of product or product defect, and possible catastrophic losses of property. The accounting principle stipulates that only events that have the potential to give rise to loss liabilities are recorded with the following requirement. The first one, the liability is highly probable or the entity's assets have been used or have been sacrificed, and the second, unless the obligation can be measured reliable. Okay, next about analyzing contingent liabilities. The reported contingent liabilities are estimated. The accuracy of the analysis depends on the accuracy of the estimates. Contingent disclosure includes the first one, describe of contingent liabilities and level of risk. The next, the number of potential contingents and how the other participants. And the last, assumption of contingent loss estimates. Okay, the next about commitment. Commitment represents potential claim to company resource based on future performance under the contract. Analysis of the commitment. The first one, analyze communication between management and press release. And second, analyze record of commitment, including description of commitment and magnitude of risk, amount, and how it is treated in assessing risk exposure, contract condition, and timing. And the third, understand possible bias for not disclosing commitment. Off-balance funding. Off-balance sheet financial is the non-recording of certain funding obligation. Example are purchase agreement and think put agreements, where the company agreed to purchase a number of goods through a processing facility, or the take or pay agreement, where the company provides a guarantee to pay for a number of goods even if it is a requirement or not. Okay, next about special purpose entity atau SPA concept. The SPA is formed by the sponsoring company and it's capitalized with equity investment, some of which must come from independent third party. The SPA increase the equity investment by borrowing from the credit market and buying asset from or for the sponsoring company. Cash flow from the asset are used to pay debts and provide a return for investor.
Shareholder equity. Equity refers to owner or shareholder financing of a company. It viewed as reflecting the claims of owner on the net asset of the company. Analysis equity must take into account several measurement and reporting standards. Such analysis will include classifying and distinguishing among major sources of equity financing, examining rightful class of shareholder and their priority in liquidation, evaluating legal restriction for distribution of equity, reviewing contractual, legal, and other restrictions on distribution of retained earnings, assessing term and provision of convertibility securities, stock option, and other arrangements involving potential issuance of shares. Capital stock. Reporting of capital stock includes an explanation of change in the number of capital shares. This information is disclosed in the financial statement or related notes. Source of increase in capital stock outstanding is issuance of stock, conversion of debentures and preferred stock, issuance pursuant to stock dividend and splits, issuance of stock in acquisition and mergers, issuance pursuant to stock option and warrant exercise. Source of decrease in capital stock outstanding, including purchase and retirement of stock buyback, and reverse stock split. Another important aspect of our analysis of capital stock is evaluating of the option held by order that when exercised cause the number of shares outstanding to increase and thus dilute the ownership. Classification of capital stock. There are two classifications of capital stock. The first one is preferred stock. Preferred stock is a special class of stock possessing preference or features not enjoyed by common stock. And then common stock. Common stock is a class of stock representing ownership interest and bearing the ultimate risk and reward of company performance. Then retained earning. Retained earnings are the earned capital of a company. The retained earning account reflect the accumulation of undistributed earnings or net income of a company since in its inspection. Retaining earnings are primary source of dividend distribution to shareholder. Cash and stock dividend. A cash dividend is a distribution of cash to shareholder, and stock dividend is a distribution of company-owned shares to shareholder on a pro rata basis. Spin-off and split-off. Companies often divest subsidiaries either in outright sales or distribution to shareholder. Spin-off, the distribution of subsidiary stock to shareholder as a dividend. Assets are reduced, as are the retained earnings. Split-off, the exchange of subsidiary stock owned by the company for shares in the company owned by the shareholder. Assets are reduced and the stock received from the shareholder is treated as treasury stock. Accumulated other comprehensive income. Certain changes in the carrying value of assets and liabilities are not included as part of net income. Instead, they are separately included as part of other comprehensive income, which is then added to net income to determine comprehensive income. Some of the items included in other comprehensive income are unrealized gain or loss from marketable securities classified as available for sale, unrealized gain or loss on derivative that qualify for hedge accounting, a pension and OPEB adjustment, and then foreign exchange translation adjustment. Under US GAAP and IFRS, other comprehensive income is accumulated over time and shown separately from retained earnings, but as part of shareholder equity under the heading accumulated other comprehensive income. Book value per share. Computation of book value per share. Book value per share is per share amount resulting from company liquidation and amount reported on its balance sheet. A simple means of computation book value is to add up the common stock equity account and reduce this total by any senior claim not reflected in the balance sheet. Book value plays an important role in analysis of financial statement. Application can include in the following. Book value with potential adjustment is frequently used assessing merger terms. Analysis of company composed of mainly liquid assets relies extensively on book values. Analysis of high-grade bonds and preferred stock attach considerably important to asset coverage. Liabilities at the edge of equity. Convertible debt. Debt issued by company that can be converted into equity shares at maturity. Convertible debt is the classic hybrid security as it is a combination of features of both debt and equity. Redeemable preferred stock. Analysis must be alert for equity securities that possess mandatory redemption provision, making them more akin to debt than equity. These securities require a company to pay funds at specific dates. Through equity securities does not impose such requirement. Minority interest. Minority interest, also called non-controlling interest, refers to portion of partially owned subsidiary shareholder equity that belongs to minority or outside shareholder. It's truly an intermediate capital form. because it does not belong to parent company shareholder. It cannot be regarded as part of the parent company shareholder equity. However, even though it belongs to outsider, it is in the nature of shareholder equity and therefore cannot also be classified as liability. Reporting under IFRS. IFRS identifies three categories of shareholder equity: issue capital, reserve, and accumulated profit or loss. However, it allows considerably latitude in how the line items within shareholder equity are reported, and so there are wide variation in practice. Broadly, the following common pattern can be observed. Share capital is reported as unspent line item. Most companies report retained earning, but few include retained earning in reserve. Reserve include accumulated other comprehensive income, option compensation, share premium, and in some cases even retained earning. Minority interest or non-controlling interest. It's shown on separately from the parent company shareholder equity, but it is included as part of total equity. Some companies report detailed component on the balance sheet, while the others report only aggregates for each category. Post-retirement benefit. Employers often provide benefit to their employees after retirement. This post-retirement benefit come into two forms. Pension benefit, where the employer promise monetary benefit to the employee after retirement, and the other is post-retirement employee benefit or OPEB, where the employer provide other benefit after retirement, primarily health care and life insurance. Analysis of post-retirement benefit disclosure is an important task, both because of the magnitude of this obligation and because of complexity of the accounting. There are 5-step procedure for analyzing post-retirement benefit. 1. Determine and reconcile the reported and economic benefit costs. 2. Make necessary adjustment to financial statement. 3. Evaluate actuarial assumption and their effect on financial statement. Examine pension risk exposure. And 5. Consider the cash flow implication of post-retirement benefit plans. I think that's all from our group. Thank you for your attention. Assalamualaikum warahmatullahi wabarakatuh.